The U.S. economy is currently being carried by a single sector. Without the massive influx of tech-related spending this year, the broader market would be hovering near a recession. The biggest tech companies spent a little over $200 billion building AI infrastructure in 2024. This year, their own estimates project that spending will eclipse $700 billion. The capital expenditure is nearly doubling every 12 months. When people talk about an AI bubble popping, they typically focus on the wrong variables. They debate whether a chatbot is going to replace human labor or whether the software is overhyped. The actual threat to this economic expansion has nothing to do with software. It comes down to physics and time. It's a strict question of whether the physical infrastructure can be delivered on schedule to justify the massive prices we're paying for it today. Big tech pushed all its chips to the center of the table on a singular wager: that the AI future arrives exactly on time. Right now, investors are happily funding historic financial losses in these divisions entirely on the promise of a massive impending payoff. This diagram shows how that payoff is trapped inside a race between two clocks. The first clock determines how long it takes to build the physical power grid. The second clock dictates how long the highly specialized AI hardware actually stays relevant. If those two clocks fall out of sync, the trillions of dollars invested by big tech will have nowhere to go, and capital will be forced to retreat without a return. Acquiring power for a data center is not as simple as plugging a building into the grid. These facilities run full blast around the clock, every day of the year, consuming immense amounts of continuous electricity. To get that electricity, a facility has to join an interconnection queue, which is essentially a bureaucratic waitlist for access to the power grid. Over the past decade, that wait has stretched from under 2 years to over 8 years. The bottleneck worsens deep inside the hardware supply chain. The highly complex gas turbines required to generate this electricity are structurally sold out through the end of 2028, largely because developers ordered 3 times global manufacturing capacity in a single year. No amount of money can speed this up. The industry already tried throwing cash at the grid, resulting entirely in inflation, not speed. This bar chart tracking the PJM grid capacity auction illustrates the cost of that delay. PJM buys promises of emergency power to protect the grid. For years, that promise cost roughly $29. When the data centers arrived, the intense demand caused the price to jump over 830%, settling near $270. The system literally ran out of physical power to buy. Grid operators went shopping with more money than ever before, paid the legal maximum price, and still failed to secure the supply they needed. The bill for that multi-billion-dollar premium is not absorbed by tech companies. It flows directly into the monthly utility bills of the 67 million everyday Americans living in that grid's footprint. The power infrastructure physically cannot keep up with AI demand. Companies have no choice but to wait, a delay that becomes fatal if hardware has a strict expiration date. Those massive data centers are ultimately just warehouses for specialized semiconductor chips. These processors are the most expensive piece of the entire $700 billion wager. The fatal flaw of these chips is that their technology ages terribly. A cutting-edge processor becomes economically obsolete and functionally worthless in just 3 to 6 years. Because this hardware is so expensive, companies rely on an accounting schedule called useful life depreciation. They estimate how long a chip will remain relevant to spread the financial cost of the purchase over time. The investor Michael Burry argues that big tech is manipulating these numbers. He asserts they are artificially stretching the useful life estimate of their servers, deliberately lowering annual depreciation costs to make today's profits look bigger. The tech giants themselves are reporting completely different numbers for identical hardware. Amazon recently walked its server life estimate down to 5 years. During the same period, Meta went the opposite direction, extending its estimates to 5.5 years to boost quarterly earnings. This rapid obsolescence creates a ticking clock. If the multi-decade power infrastructure arrives late, the billion-dollar chips it was built to run will have already expired. How did the entire energy supply chain and hardware cycle become so violently backed up? It is not because AI is failing. The technology's overwhelming success is causing every company to demand massive power at the exact same time, breaking the grid's capacity to deliver. Simultaneously, the constant improvement in AI technology intentionally cannibalizes its own market. Every new generation of chip immediately kills the value of the generation that came before it. AI's success actively works against itself. The explosive demand floods the grid, slowing down the physical build-out, while the rapid tech advancement kills the chips, speeding up their expiration. Success wins both clocks against each other. This diagram maps those timelines together, highlighting an unavoidable mathematical mismatch: an 8 to 10-year wait for physical power, colliding with a 3 to 6-year lifespan for the AI chips. This chart of project delivery odds shows the race is already being lost. Goldman Sachs data reveals that for future AI capacity projects planned just 2 years out, the odds of arriving on schedule drop to 50%. This bar chart comparing chip sales to grid supply projects projects an enormous 63 gigawatt gap by 2033. To put that in perspective, that deficit is larger than the 40 gigawatt capacity of every single data center currently existing in the United States combined. Fulfilling the AI future that big tech has already purchased requires generating a volume of power that is mathematically and physically impossible to deliver on our current infrastructure. The AI bubble will not pop with a loud technological failure or a broken algorithm. It will end in a quiet exhaustion of capital. The crash arrives the moment investors realize the physical reality of the grid cannot support their expected financial returns, prompting them to take their money somewhere else. The ultimate fate of this massive economic boom will not be decided in Silicon Valley. It will be determined inside the boring pages of government capacity reports and corporate depreciation schedules.